Hello and welcome to the How2Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. Hello and welcome to the How2Exit podcast. Today I'm here with Jon Taylor. Jon is the author of Maximize Your Multiple, the Business Owner's Guide to Institutional Money Deal, a book that helps entrepreneurs build and sell their companies for maximum value. Jon has over 20 years of mergers and acquisitions, strategic advisory, and business valuation experience, and has successfully advised clients across the broad range of industries, including government services, aerospace and defense, business services, technology, consumer and industrial products, metals and mining. He has closed over $2 billion in aggregate transaction value in his career. Welcome to the show, Jon, man. Thank you for being on the show today.
Thanks so much for having me.
Cool. We were talking a little bit earlier. You know, my first question is going to be the origin story, man. You were born, now you're on my show. Kind of fill in the gap at how you got here today.
Sure. So I got out of school. I went to the Wharton School and graduated in the late 90s as an undergrad, and which was an interesting time. You had referenced Excite, right? So that was right during the whole .com craze, 99, 2000. And, my first job out of school, I studied finance and was just interested in Wall Street. I remember watching Wall Street as a kid and just thought, that was a really interesting movie. I think Oliver Stone didn't meant to be like a movie, but I think a lot of people in my generation just got turned on to Wall Street, right? So I'd read Barbarians in the Gate in college and some other deal books like that, and so started off doing middle market investment banking. A lot working with some tech companies early on, and enjoyed it in a lot of ways. But at the same time, there's all these kind of a lot of people were heading into .coms and I did spend, I did try kind of the internet thing out for a little while, but came back to banking and, had worked with a couple different firms over my career, founded my own practice 7 or 8 years ago. And, haven't really looked back since, just been doing middle market mergers and acquisitions, typically companies, 10 to 20 million plus in sales. And then we have a very active business valuation practice as well.
That's awesome. You said you mentioned the Wall Street movie, right? The funny thing was when I decided to go into M&A, I actually sent a message to. I called a friend of mine to tell him, because we used to watch that when I was in the military. Him and I would watch that show like over and over again, and we were trying to figure out if we were going to be stock traders or whatever, right? And so when I decided to go to this, I tried to get a hold of him. I couldn't get a hold of him, but his wife answered, and she's like, "You want me to send him? You give him a message?" I said, "Yeah, I'll tell him Blue Horseshoe loves Endicott Steel or whatever." And she's like, "What?" I said, "Just write it down and tell him that." And so he texted me later, like, "What in the world's going on?" He's like, "I moved to M&A," and he's like, "Oh man," So it was just one of like, this is something 30 years later, right? So that movie is an iconic, probably catalyst for a lot of people to eventually get into this space. Now you're in the heart of tech. You're right there in Palo Alto. We were talking about a little bit before the show. I lived there in that area for 9 or 10 years, and so you're surrounded by tech companies and stuff. But we were talking. You do valuations of everything from the local hair salons all the way up to the big tech and everything in between, right?
That's right. So our valuation practice, we work with companies of all sizes. On it could be anything from divorce litigation to 409A is very common for stock option valuation for businesses, and partnership buyouts. Different types of litigation. I mean, we've been an expert witness in court, so that there's lots of reasons why people do business valuation. But M&A is the biggest part of what we do and what we enjoy doing the most. And so representing middle market businesses and sell side. I mean, we've done some work in tech, but also some industrial construction type businesses as well.
So it's interesting is valuation's a brilliant, like almost a lead generation for your M&A side, right? Somebody comes to you and they're like, "Well, what is my company worth?" And you help them with that, and then it leads to, "Well, what are you planning on doing?"
Exactly. Yeah. That's the way some of our sell side conversations begin. Is people come to us for evaluation, and we turn it into a sell side opportunity.
That's awesome. So I'm a business owner. I come to you and like, I think I might be ready to sell this and stuff. Could you help me work with what is my business worth? Now we've had a lot of conversations on the show about like how to maximize value and like get your book straight and all that. But what does the process look like to start an evaluation process, or actually not evaluation, but valuation?
Sure. So typically we start with a questionnaire and understand what the business does, what industry they're in. Getting the financial information. We have an information request list that we send, which is really looking at the last 3 to 5 years income statement, balance sheet, um, understanding who owners are, what the ownership structure looks like, um, understanding what does the customer base look like. Are there things like customer concentration, any significant risk factors? So we have a short questionnaire we run through with folks at the beginning just to evaluate a company and understand what its value might be, what the different options if they're looking to sell it, what's kind of their strategic alternatives. So obviously, I mean, larger businesses have more opportunities for selling than smaller. But a lot of small businesses are very difficult to sell because they're in a lot of cases they're just too small to be interesting to a buyer, right? I mean, if someone's going to spend a lot of time doing diligence and audits, mucking around with a tiny mom and pop type business, oftentimes isn't a good use of their time. So they're looking for significant opportunities. Companies doing I'd say at least 1 million plus in profits. These, I mean, usually, often.
Right. So uh, I'm coming to you, and I'm going to play a scenario up because I kind of know. I know you get this because I get it as from a buy side, um, conversation is, you know, a seller or a business owner. They come to you and like, look, I'm wanting to retire. I want to sell my business. I need X. Is there a strategic side of how you like how do you get them to X? So I talked to my financial advisor, my CPA. He says, in order for me to retire and live the life I'm currently living, I need another $2 million, right? And
Sure.
you and I both know that what I need and what the business is worth are not connected in
Right.
any sense of the matter, but in their mind, it's connected, right? They're looking at their
Yes.
business going, I make 5 million a year, revenue. So yeah, I probably can sell this for 2 million, and that's not connected either. So walk through the conversation that happens for valuation and like with the seller as far as like, do you have to set some expectations, or is there what's the conversation look like?
Yeah, that's an important part of the process whenever we evaluate a business for a sale. I mean, we get the financial statements, we go through a questionnaire, we get information on the customer base, the market they're in, and then we do our own evaluation of the business of what we think it's worth, what we think bids might come in if we were to market the company actively, and then we present that to the potential seller and say, hey, look, we think the value is going to be in this range, right? So, uh, oftentimes it's a multiple of EBITDA, maybe a multiple of sales, and and obviously there's could be significant variance between like a high end range versus a low end range, and everyone likes to be optimistic and say, hey, it's possible that we could get you, 20 times EBITDA for your business, or 20 times sales or something like that, and that's what everyone wants to hear. But we want to try to give them a realistic picture of where 80 to 90% of bids are going to come in, because it doesn't do anyone much good if we're just blowing smoke and making them feel like, hey, your business is more valuable than the market might perceive it to be. I mean, it's an honest conversation and just say, hey, this is where we think most people are going to bid, and realistically, these are what your options are going to look like. And we say with the caveat, like, hey, we'd love to get you more, and we'll try to get you more. So if we can't come to some agreement there on a reasonable value, if someone's like, well, hey, I want 2x what you're saying it's worth it, we might say, hey, look, we might not be the right people to represent you. I mean, we can certainly try to get you that number, but we don't think that that's um, that may not be the compensation we get is about a result. It's because it's typically a percentage of the deal, and so we don't want to spend our time marketing a deal if we don't think if we can't see eye to eye on what the value is, and eventually get to a price, right? Think about a homeowner who hasn't maintained their home in 30 plus years, and they got outdated kitchens and bathrooms, but they want premium price to sell, right? It's if you're a realtor, you'd probably say, hey, I'm going to decline that listing because it's just we're not going to get to a deal, right? So that's we try to take a similar approach.
One of the things I find is I don't I'm not an advisor in the sense that I'm trying to help them sell it to somebody else. But when I'm working with the seller, the first thing I say when they say, well, I need 2 million, my response is always going to be, let's see how we can get you there. And a lot of times that how we're going to get you there is we've got to increase your profitability, your EBITDA. And there's a couple ways to do that. You can become a lot more, if you got the revenue, you can become a lot more efficient, right? And drive that number up. Or if you don't, we could probably go acquire something similar to yours and drive it up pretty quickly and sell it all as one. And so there's some conversations I have with business owners who they think they need X, and there's just no way their business in its current state will get there. I do take a piece of that. Do you guys do any type of strategic advisory? Like, well, we'll help you acquire something to help you get there, or you stay inside of the sell side advising?
Sure. Yeah, no, we definitely tell people, like, look, if there's a certain number you're targeting, you need to grow the business for another year or 2 or 3 years or whatever the plan is. And maybe the best way to do that is to look at an acquisition, or maybe there's ways to increase the profitability that they haven't looked at, right? Or haven't considered. It's interesting because, you meet business owners all the time, and, they're not, a lot of them aren't really optimizing everything they're doing, right? They, maybe they're wasting money on things that aren't a good investment, or they need to really focus on growing the top line, maybe investing in the right kinds of people that can help them get there. So we do give that sort of advice as well.
One of the things I work with some of these guys is it was at finding kind of the red flags. So, are there red flags outside of the financials, outside of that that customer concentration, 3 years financial? Like, what are some of the questions you ask a seller when they come talk to you that are outside of numbers?
Yeah, it's a good question. There could be risk factors, compliance issues, legal issues, right? Regulatory issues. There are some industries that are more regulated than others. There's environmental, right? So if you're a manufacturing business, have you had a phase one done or phase two? Are there any toxins in the soil? Like, we've worked with companies. They had to have a phase one, phase two environmental, drill holes through the floor of the plant, wells to kind of test toxin levels and so forth. We had a client that, one of their factories was built on a former coal ash plant, right? So, I mean, those are big risks. Like a law can certainly be an issue. Employment issues, hiring, do you have a management team in place that can run it? I mean, that's an important consideration. If particularly, I mean, you referenced the private equity world, right? I mean, most of those guys aren't set up to drop in a management team and run it. I mean, they may have operating partners that can help round out a management team, but really they're looking to the company to have that has a good leadership team already in place. So those are the intangibles for sure. Yeah, I mean, do they have, how do they differentiate themselves in the marketplace? Do they have a good sales message? How effectively are they marketing? Are they using digital marketing, if that's effective, right? Their whole approach to product development. Do they have intellectual property? I mean, all those things certainly come into play. Product concentration. Are they very focused on a single? Is it like a company, right? I mean, we had a customer that they made where it was a certain type of truck cover, and so it was like a one product type business, right? They weren't very diversified, so they had to look at diversifying their product offering so they can provide have more of a value added type offering to customers beyond what kind of a single product model. So yeah, I mean, all those things come into play.
So let's go jump back right into that valuation. You mentioned intellectual property, and I haven't had anybody on the show that talked about how do you add intellectual property into the evaluation equation. And I kind of suspect you're uniquely set up to talk about it because you are surrounded by tech and innovation. So with your defense contracting stuff that you had in your bio and stuff, you've got to come across this. So Is it swag, right? The scientific wild ass guess, or is there a method to valuing intellectual property as an asset of a company?
Sure. So we have done valuations specifically for a company's intellectual property, and a lot of times that's can almost be like a theoretical exercise where you look at royalty payment on what it be type of intellectual property, right? Software code, which maybe they're not monetizing, but it could provide cost savings, right? Maybe they need to hire, they don't need as many people, so it provides a cost savings to the company by automating certain processes, right? So those are, so even if the software or the intellectual property is sold, but does it provide some other type of benefit or advantage to the business in terms of cost or how the company's marketed? But yeah, I mean, we come into this question quite often. Sometimes when a company says, well, hey, my business might be worth X, but my brand is very, an awesome brand, or we've got all these patents on products that sometimes haven't even been developed, right, or marketed. So that and when you're talking about selling intellectual property assets like that, I mean, it can be somewhat challenging because it's different when you're looking at valuing intellectual property from, maybe if you're looking to do it for, tax compliance or some, some theoretical purpose. But really, if you're asking a buyer to pay for real intellectual property, I mean, it should show up in the financials. So if you have real intellectual property that's valuable, you should have some cost advantage or quality advantage. You should have better margins than your competitor, or you should be penetrating the market faster because your intellectual property makes your product superior. So it really should show up in the numbers, and it helps to certainly having the intellectual property secured. I mean, patents, right? I mean, typically it's a 17-year life, so the life of the patent matters oftentimes. But yeah, I mean, the reality is the intellectual property, it should show up in the numbers. And I mean, a lot of companies, their proprietary, their secret sauce, it hasn't been patented, right? It's kind of a trade secret, but things they know, or they call it, black magic or whatever. And, it's how they go to business, and it's not necessarily, written out or explicit anywhere, but it's a method in the way they do business that's valuable. And it shows up in the results, in the financial results.
So you've been in this industry 20 plus years, according to your bio, right? What's your favorite deal? Like, and maybe think kind of back through the deals you've done and been involved with your current firm and other ones. Do you have a favorite and some lessons learned from that one?
Yeah, every deal provides its. I mean, every deal provides its own unique set of challenges. So I learned something from all of them, right? And a lot of those are, it's oftentimes it's interpersonal, right? It's the interpersonal dynamics of the seller and understanding what their needs are and really listening to them. Just recently we were kind of deadlocked on an offer with a business, and kind of going back and forth with a letter of intent, and it looked like, hey, this deal might not come together because the sellers wanted to exclude a certain software asset from the sale. The buyer wanted to include it, and they were, you know, kind of fighting over to some degree whether or not it should be included, and what the value was, and this was more of an early stage type software asset, so it was difficult to value. So yeah, I mean, every deal presents its own unique set of challenges, and it's in. I had a client, gentleman, well into his 70s. I mean, he had essentially retired from the company. It was a business in the industrial manufacturing space, and he had moved to Florida, but was still somewhat involved with the company. And we had this. We got a pretty good offer for business, and one thing he had, I'm understanding what's called a network capital target, because typically when you sell a business, it's the valuation of the company, it's on a debt-free, cash-free basis, right? So what that means, if you're the seller, you get to keep any cash that's in the business, but you got to pay off any debt, and an amount of what's called working capital, which is the company's inventory, accounts receivables, and payables, which stays in the business. I mean, that's kind of your inventory and accounts receivables is basically, it's that the owner has made in the time to build up an inventory balance and accounts receivable balance, which eventually gets turned into cash, but also they build up a payables. And usually, so typically you take the non-cash current assets, you deduct the non-debt current liabilities. That gives you the working capital, and you typically look at a 12-month average for that number. So whatever the trailing 12-month average is usually set as a target, which is included in letter of intent. So when you close, if you're above that working capital target, the seller gets a credit, and if he's below, it's a debit. But out of business owners, we've never dealt with this concept before, and some of them really struggle. I mean, to spend, one case I had to spend probably over 40 hours educating him on why working capital has to be included, what it means, how you calculate it, why we're using an average. So a lot of it is just seller education, and so yeah, I mean, a lot of clients we have are first time business sellers, and they're not super sophisticated. While they know their industry well, they're experts in their industry, and they know everything about it in terms of, but actually doing a deal is something they're very new to, and so they're learning a lot of these terms for the first time. And so yeah, we often have to spend a lot of time educating them and helping them understand why an offer is written a certain way. What working capital is, how long it takes to close, what's going to be diligence, right? So there's all these different kind of technical references we have to get them up to speed on.
Yeah, I've actually run into a case where I had an LOI out. I thought everything was going good, and the owner, at some point after he signed the LOI, come back because you do realize I'm taking all the inventory and all the cash as part of my retirement. And I was like, "What are you doing with the inventory?" Well, I've got a buddy that owns something down in Texas, and he's gonna buy it for me at my cost. And I was like, "No, I'm not interested in an
Right.
empty warehouse with a bunch of employees, and orders to fill. I want to be able to, the inventory. I need to be able to ship things as things going out." But he thought he was getting a bonus. He thought he was going to pull over $1 million worth of cash out of the business, and $500,000 worth of inventory, which at his wholesale cost, and my price was okay if he got all that. I was like, no, that's not how this works. So I can see that. A lot of the
Yeah.
a lot
And
of
I was going to say too. That's why it's so important to set a working capital target in the letter of intent, because you don't want to set up a situation where because once the LOI is signed, the seller's basically incentivized. I'm going to draw down I'm going to give all my customers a discount to pay me early, and I'm going to sell off this inventory and try to basically raid the balance sheet, and then run up my payables. So when the buyer takes possession, there's almost no inventory or accounts receivable, and my payables have run way up. And so you don't want to create a situation where you're incentivizing either side to play games with the balance sheet, right? Because if you're the buyer, I mean, yeah, you'd want the inventory and A to just increase and the payables to go down. But to be fair, you set a target, and then if you're above or below it, there's a debit credit at closing.
Let's talk a little bit about, we've got the valuation done, and the owner is still in, and I'm sure you get this. A lot of times it's either a forced sale, meaning it's a health issue, or a divorce. We talked about that a little bit earlier. But in some cases, it's just a lifestyle choice. They're thinking and it's time to sell. I run into some cases where we've got pretty close to the finish line, and the owner decides to change his mind because he doesn't know what he's going to do next. Do you work with any type of like transition specialist or anything that helps the owner figure out what they're going to do next, so they don't pull that knee jerk reaction towards the end of the transaction?
Yeah, no, it's a great question, and it's funny because I talk to business owners every day. I mean, as you can imagine, and I go to trade shows sometimes, and I meet business owners, and I always kind of chuckle sometimes because I'll meet some of these guys that are well past retirement age, well into their 60s, 70s, even 80s in some cases, and I say, hey, would you consider? Are you considering a potential sale of the company? Is that something you'd like to do or would consider? And a lot of them are just like, no, I'm not even thinking about it. I'm not looking to do that. I enjoy what I'm doing. And you think like, hey, like this guy's ripe retirement age, but it's like a lot, the way a lot of these entrepreneurs are wired, they're not even thinking about it, right? They just want to keep doing what they're doing, and this is their purpose. So yeah, I mean, certainly working with the business owner. I mean, obviously, it really comes up to educating them and talking to them up front, making sure that, hey, this is what it's going to take to sell the company. We're talking, it's going to be a lot of work. It's a long process. It's not something that you can't, hire us to sell your company on Monday and expect to be closed on Friday. It's a big investment of time and effort. So we want to make sure that they're committed to the process. I mean, yeah, like you, I've had instances where the owner second guesses himself, or decides he doesn't want to sell in the end, and that's unfortunate. But yeah, I mean, at the end, it is the seller's decision, right? I mean, it's our contract doesn't obligate them to sell if they don't want to sell. So, but yeah, I think the key there is just remind them, like, hey, we're working to bring you the best deal possible, and whatever deal we bring you to recommend, it's going to be a good deal that's going to within the valuation range we discussed and on the terms we discussed. And so we say, hey, look, we're going to bring you the kind of deal you're looking for. And if we do that, we want to move forward and get something done, because that's what we're all here for.
The other side of it is that a lot of times when you're working through all the stuff that needs to happen to make a business really valuable, you run into what I refer to, I jokingly call it the freshly decaled car scenario, right? You ever decide you want to sell your car and you go out and you get it cleaned and detailed and serviced so you have the highest trade-in value, and then you're driving over to the car dealership to trade it in, you're thinking, I don't know why I'm selling this. It's a pretty nice car, right? Same thing happens to some of these business owners when they go through the process of, they bring in a general manager so they're not having to put in so many hours. They put in systems and processes so somebody else can run it. They clean up their financials and get things tuned up a little bit so that it's more profitable. All with the pretense that they were going to sell it. But when they get down to that other end of it, they go, okay, well, I only have to spend 4 hours a week here now. Why would I sell this? Do you run into any of that too, where you put in the work to help them make it very marketable, but now it's also something that's a lot easier to manage, and they may or may not go?
Yeah, it does happen for sure. I mean, or people that even second guess themselves, and sometimes we have to spend more time with them. Like the deal we did with this gentleman that was, I think he was almost 80 years old. He was kind of questioned sell. I said, hey, look, this, you sell the company, you kind of insure its future to some degree, right? I mean, like, you have to think about what happens if you're to pass away, what happens to the business. And obviously putting the kind of systems in place you need, having a management team in place. But yeah, if you want the best thing for the company, sometimes the best thing for that is for you to step away, both from management and an ownership role, and let someone own the asset who can really maximize it and continue to grow it and do the best thing for the employees. I mean, this one gentleman who was in his late 70s, he wasn't investing in sales and marketing, wasn't his approach, like no debt, didn't invest much in sales and marketing or other things to grow the company, but had a great business overall. So I think the company was in a position where it really needed a different kind of ownership to run it and continue to grow it and develop it. So I think if you're an owner that can recognize, like, hey, maybe the company's at a point where it needs to grow past me in my financial or risk tolerance or ability to grow it, I think thinking about what's best for the employees and the business can maybe help them get over that. Because I understand the emotional attachment. I mean, you spend, a lot of our clients have spent 30, 40 plus years building a company, and it's hard to walk away from, right? There's that emotional attachment. It's been an investment they understand. It provides them steady capital. Like, hey, why would I sell this, right? But there are lifestyle factors to consider for sure.
So what would you consider as the most important piece of advice you give to an owner who's thinking about selling his business? He's considering an exit.
Important thing I think is the amount of to sell a company oftentimes, and the amount of information that has to be provided, right, and getting the business ready to stand up to that level of scrutiny and to be able to answer questions and generate reports, right? I mean, having good software systems, information systems that can generate financial statements and lists of customers and projects and sales by product and profit margin and things like that. So having good IT systems, having the right kind of people in place. It's great when a company has a chief financial officer. I understand there's a lot of small businesses that maybe don't have the budget to afford one. If you're a company doing 20 million plus in sales with decent profitability, I mean, having a CFO can really help you position the company and help you get the systems in place you need to operate it, to provide efficiency, and then also during a sale process, just being able to generate reports and information quickly. Even for yourself, to help you operate the business. So, yes, systems, there's things written down is important, right? Because a lot of businesses start out with a one man band who's doing 4 or 5 different jobs, and he's been kind of running it by the seat of his pants for years. But stepping away from some of those roles, hiring professionals to do those same jobs, um, writing down procedures, right? Explicit, uh, you know, manuals on how to do things and how the business is run. Having good documentation is very important, and it makes a big difference in a sale process when you have good documentation versus, someone asks you for, um, your list of customers, or sales by product or something like that, and it takes you 2 weeks to pull together. It can really hamper a sales process. I mean, you have to be able to generate information quickly and answer questions. So that's something we always recommend.
I can tell you from the buyer's perspective, and I work not just myself, but I work with a lot of other buyers. For everything we have to wait for, your price, your what we think the value of your company kind of goes down a little bit, right? Because if you're creating it on the fly and you haven't tracked it closely over the last 3 years, we have to kind of assume there's some fudge factor in there, right? You didn't have it readily there, you dug it out, you were in a hurry to dig it out. And it's kind of like the guy that waits for the last minute and creates a mileage log for his, kind of tries to go back and create a mileage log for his tax deduction on the use of his car,
Right.
right?
Right.
They got six different pins and they're trying to create it, and they know it's pretty close to accurate, but it's not 100%. That's kind of our perspective when I ask you for something as a buyer and it takes you 3 weeks to get it to me. I was like, he's having to go out and create that, right? And if it's
Right.
something like your profit and loss statement, broken up quarterly over the last 3 years, or your or just financial stuff, that induces a little fear into your buyers. So one of the favorite things I always like to ask is, what do you believe is a common myth inside of this profession, inside of M&A, inside of advisory services? What do you believe is a common myth in your profession that you'd like to debunk right here and now?
I mean, a common myth. Yeah, good question. I mean, there's a lot of them. I mean, one thing I think that I mean, there's this whole idea. I think I went to business school, and we talk about like the strategic buyer is the best buyer because he can afford to pay a premium and so forth. And I think a lot of times that can be true, but in some instances, I mean, a lot of private equity buyers are just as aggressive as strategic buyers when it comes to buying businesses, and their valuations can be in the same range as a strategic, right? And so some people don't want to consider a financial buyer because maybe they feel like private equity has a bad reputation, or a private equity firm bought a friend's company and they don't want to deal with private equity. Yeah, I mean, I think that's a fairly common one. I mean, some business owners, you know they feel like they can sell the company themselves, right? And it's like, I mean, I recently sold a home, and I guess I could have done for sale by owner, right? But there's I understand there's a cost to hiring a certain professional. I mean, you look at what kind of commissions get paid to realtors these days, and it seems kind of ridiculous with Zillow and the internet, and you're still paying 5% or more to sell a home. But it's there's value in having a professional that's done it many times help you in a transaction. And trying to do everything yourself, I think, is a mistake, right? I mean, you wouldn't write all your own legal documents oftentimes, right? Hiring a professional who can save you a lot of time and money in the end.
It's interesting. I've had sellers ask me, like, should I have somebody on my side? And I was like, look, I'm negotiating this to be the buyer. I'm going to negotiate this to be in my best interest. I'm not out to harm you or anything, but I promise you, if you have stuff that I don't recognize or don't understand, I hire in people and I bring in advisors. They look it over and give me advice. I would recommend you do the same thing. right? You're not going to understand this, and quite frankly, I may or may not be equipped to be the guy to teach you. You know, if I was selling my, I just turn it around. If I were selling my company to you, I wouldn't ask you to teach me what I'm presenting to you. It's just a bad idea, right? And I don't have any malintent towards these guys, but just being as straightforward and as honest is like, I'm going to bring an advisor in if there's something I don't understand, and yeah, you probably should do the same thing. So,
Right. Yep.
and the same thing, I've got a background in real estate investing, and to this day, I still maybe because of time requirements, but if I decide to sell something, unless I have somebody lined up that wants to buy it, like I have some properties right now that are owner financed out. I've got somebody that might want to buy the notes. I'll probably do most of that myself, and then when I'm ready, when it's done, because I know the guy, he knows me, but I'm still going to take it to. I know how to do the paperwork too. I can do it right
Right.
here and bring a
Right.
notary over to the office and have him notarize it. I know how to do it, but just for his well-being and his comfort zone, I'll pay the money and go to a closing company and transfer the title and everything through a closing company because they can insure the transaction, they can oversee it, they catch anything I might have missed. It's a peace of mind for both parties, and so I would say if you've got, unless you've got a mom and pop shop that you're just selling to a friend, a family, a relative, or something like that, it's absolutely a good idea to bring in an advisor to take a look at what you got and pay them. You know, I say that, and I don't fish through biz buy sell or anything listed for businesses because there's just so many out there that let's just say most, not most. What's the word I'm looking for? Not all brokers are even are equal. All right, there's a
Right.
lot of stuff listed out there, and like we were talking about valuations earlier. There's a lot of people out there that I think there's the reason a lot of businesses don't sell off a biz buy sell. I think they have like a 20 or 30% close rate. It's not very high, and
Right.
it's because the valuations were done incorrectly, right? When it comes down to
Right.
the brass tack of things, businesses are worth what the market will bear, and it's the job of the advisor to know what that range is. Now he can list it for something higher than that, but he should know in the back, in his heart of hearts, soul of souls, that that's not where it is, right? And it sounds
Right.
like you guys put the homework in to know,
Right.
like, hey, I'll list your business for 2.5 million if that's what you want, but I would really suggest in 3 or 4 months we lower that because it's probably closer to 1.5 or 1.8 is where it sets. You know.
Yeah, and I should say too. I mean,
Okay,
oftentimes
so
when we're marketing a business, we don't necessarily set a list price, right? So I know it's very common to biz buy sell, though. But when we market a company, typically we're dealing with investors, private equity firms, strategic buyers who do a lot of deals. So, looking to them to give us a bid. We're not necessarily asking for a specific price. I mean, there have been instances where, I mean, to me, there's no or sophisticated buyer or price because they're paying, they're just down. So it's best to let the market set the price, talk, collect bids, and then you'll see what the
it's interesting that you said that because that's one of the number one things I've heard when I talk to businesses who have business owners who've already sold. I asked, like, did you make any mistakes? Yeah, the biggest mistake, usually not usually, but they're more often than you would expect. The mistake was I told the buyer what I needed, and we ended up pretty close to that. And I was like, well, how's that a mistake? I think if I'd kept my mouth shut, he'd have offered more, right? There's even one of my favorite podcasters was talking about the company he sold, and he said the biggest mistake he made is they asked him if his business for sale. And he said, "Yeah, if I got in this range, I would sell it." And the offer come right in that range. Now he either has to go against his own word and say, "No, I want more," or just accept the range he gave them. And he thinks he left millions on the table because they were in the upper side of his range. But had he not done that, he found out later that that same company had bought similar assets for more. So let's look at let's kind of just real quick. We're about 40 minutes into this. Let's make sure everybody knows how to reach out to you. I've got your name and your website up on the screen. So if any of you guys are watching this on live or you're watching this on YouTube, we got the video up. It's available, and it's Jon, spelled Jon Taylor, Taylor, and it's at his website is Stanton Park LLC, Stanton TonParkLLC.com. That will be in the show notes. And let's go ahead and put up your LinkedIn contact information too. So if you're looking for him on LinkedIn, it's Jon, JonTaylor Finance. So his LinkedIn URL actually has Jon Taylor Finance on there. And there's quite a few Jon Taylors. I was looking for you today because I thought we were connected and everything. And I think, man, I've had about like 6 of them I'm connected to around the world. Like, that's not him. That's not him. So the URL is on the screen now. It'll be in the show notes for the show. And for those of you guys that want to reach out to him on LinkedIn and get a connection there. Now, do you do business outside of the California area, or is just California for now?
I do. Yeah, we work nationwide, so we present businesses all over the country.
Cool. So I didn't want everybody to see like your profile and goes like, so they do that to me. Like they'll look at my profile like, well, you're sitting in Tulsa, Oklahoma. I got a business down in Dallas. I was like, does it make money? And they're like, yeah. Then I want to talk to you about it, right? I I like money. I like money wherever it's made. And
Right.
if you got a great business, I'd like to hear about it. And one of the things I tell people at times, like, look, I may not be the perfect buyer for you, but as the connections I'm making out there, I probably know one that is. So let's go ahead and talk about what you got going on, and there's been more than once where I've said, "Hey, you really need to clean this up a bit. Why don't you work with somebody that's a strategic advisor in the sell side? Work with them. It's going to take you a year or two and come back to the table because what I'm going to offer you right now, you're not going to like. I'm going to offer you between 1x and 3x because your finances are a mess. You're running this thing yourself. I'm going to have to bring a team in, and you're close enough to that P&E level that if you had all that fixed, you'd be in above that 3x mark, 5x, 6x, whatever PE, 10x, depending on the PE or the private equity company and or the strategic. I've asked you a lot of questions, and we're at the 40 something minute mark. What should I ask? Right? What's a question like, man, we should probably talk about this topic. Is there anything on your mind that like you're hoping I get around to?
No, it's a good question. Yeah, I mean, I think maybe we touched on this before, but I think that the big opportunity with business owners is, probably I think it's in my book. I kind of go through this, but something like fewer than 95% of 95% of businesses are not saleable, right? So we're in businesses that like private equity or strategic buyer might buy, really only 2 to 3% of businesses even qualify for that kind of a buyer, right? Because they're not a big enough company. Their sales and profits just aren't high enough, and so I think there's a big opportunity for business owners to think about how they can grow and expand their business, right? Overcoming things like customer concentration, risk factors. I think we had touched on that a little bit before, but those are things. I mean, maybe I'll put a plug in for my book. I mean, that's pretty much what I work because I saw there's this huge kind of bottom of the pyramid opportunity for business owners where if they're focused, if they commit resources, that they can significantly grow their business beyond where they are, and maybe look at doing an institutional type deal down the road where they can sell for a much higher multiple rather than kind of the 1 to 3x multiple range you mentioned, right? Because that's where a lot of small business owners end up because they haven't put the resources into making it a more sizable, profitable venture.
A lot of business owners don't realize there's actually tiers, right? Right now, I'm hearing P&E firms are dipping down into the seller's discretionary earnings and slash EBITDA down to almost the 1 million mark, at least the 1.5 million mark. So the institutional money, if you're producing a million or more in profit or EBITDA, uh, then you could probably pick up some interest from those guys. A lot of guys don't understand, or a lot of business owners don't understand that there's these tiers, right? If you are below that mark, you're probably going to get 1x to 3x, right? If you I see a lot of things like let me think off the top of my head. Pool cleaning service companies that service and maintain swimming pools. A lot of those sell for 1x, right? It's just
Mm-hmm.
and which I'm looking at them because I get my money back the first year. I'm interested. So, but we got 1x, but if they can get their EBITDA, and maybe it's 3x depending on the industry. And if you're in software, that this goes out the window, because if you're a software as a service, there's some crazy multiples that those guys get and stuff. But that 1 to 3x is typically underneath that $1 million in EBITDA. Is that still what you're seeing?
Yes, yeah, I would agree. I would
Yeah.
agree. To get a bigger multiple, you've got to be over $1 million typically, and usually, 2 million plus.
And I think if you can get to, even through whatever means, if you get through it through mergers and acquisitions, you grow your customer base. Let's just say you hit 2 million, that multiple it can go from that 1 to 3x to easily 5, 6x or above. So you're seeing this. I mean, you've been in this industry for 20 years. I've been in it for 2.5. So does that ring true with you too? Is that like the multiple is
Yes,
almost twice? Yeah. And then if you can get to
yes,
the
yeah,
idea,
yeah.
yeah.
I agree.
And a lot of people don't like. A lot of people will Google like what's
No, yeah, yeah. So, sorry, I agree. I mean, if the company can get to that level and grow significantly, the multiples are, yeah, they're pretty much double or more what they would get for much smaller businesses.
a lot of people will Google like what is the EBITDA multiple, and they'll download that chart, and it says, well, marketing agencies get 12x. And I have to come back to go, they get 12x, but the people that are paying 12x for those marketing companies are buying companies that have 10 million or more in EBITDA. So there's
Right.
another level. There's these tiers. For guys that do acquisition mergers, we kind of look at it as an arbitrage. If I buy one company that's doing under a million, I merge it with two or three, we get to 2 or 3 million. I could buy them for 1 to 3x, sell them for 6 or 7. And if you want to hang in the longer game, own them for a few more years and get it above 10, I might be able to get what they call industry multiples, which might be 10 or 11 for marketing agencies. It's the one I know because we did a roll up last year. But, construction materials, was looking at that industry for a little bit. They're 11x. But you get 11x as you're producing 10, 15, 20 million in revenue, I mean, in profits a year.
Right. Yeah, I agree with that.
Cool. Now, the other thing is a lot of these small to mom and pop shops, they're hearing that they should do strategic purchases or strategic acquisitions. Like, that's who should be their buyer. But I I think I think a lot of those owners, and like I said, I'm new in this space. But I think a lot of those owners, that's not who they want to buy their company, right? A lot of these guys that are mom and pop, they're doing less than $1 million a year in profits, and they're wanting to sell. One of their biggest concern is what I call a safe pair of hands, that their employees, their staff is going to be left with
Mhm.
somebody. More often than not, you sell a strategic purchase, there's a pretty good chance that they want the customer base, they want the product line, but they don't need your accounting team. They don't need your HR rep. There's going to be some synergies across the two companies, and your sides decide to go. So I've seen two in the last 2 years where they got to the finish line, what they thought were going to be a really beautiful exit, and they found out that the acquirer has no interest in any of their employees, and then they didn't sell it to it. They actually took a much lower price from somebody else.
Oh, wow, wow, that's unfortunate.
Yeah. So that's something and in hindsight with him was like that's something that he didn't have an advisor. I know the guy, and I was like, why did you go into a deal with your level of company? He had 52 employees. With your level of employees, your level of revenue, and not have somebody on your side, because that should have been discussed on day one as to what are you going to do with this, right? They just seen the number. This guy, the company came in, offered them a substantial, like an 11x offer on their income, on their what he called the profit, but it was at EBITDA. I looked at the offer and the LOI, and he thought, well, 11x, I don't have to work no more. I'm retiring. And then he realized that he's the only one getting a check, right? That everybody else is going to get laid off towards the end there. It was just a conversation, that happened after during the due diligence process. He's like, well, do you need my employees? Do you need my HR stuff? And they were like, yeah, we maybe later. They kept pushing that off. And he
Oh man.
finally asked the right question. And I was like, so in this case, I would say if you've got more than a couple dozen, or even, I don't know what the number is, but if you've got enough money and or a sizable enough business, it's not a bad idea to have somebody on your side, to tell you, wait a second, they're not asking for HR and personnel records because they don't need those. You need to know why they don't need them.
Exactly right, and oftentimes the way the letter of intent might be written can be confusing to a seller if he's never read one before, And yeah, there's nuances to the process they might not pick up, and they could spend a lot of time going down the road with a buyer that isn't going to buy the company on the terms they represented, right? So I've seen business owners, they'll engage in months and months long conversations with a buyer. Nothing ever happens. It's like, well, hey, did you ask him this? Did you ask him that? They're like, well, I didn't. It's like, well, yeah, they weren't a serious buyer. So things like that. It's can be very helpful, like you said, to have an advisor in your corner and help you get towards the path of a sale.
We're at the 50-minute mark now. I keep wanting to. Man, we could talk forever on this. Most of my just like most of my guests, I get on here, we get in the groove, and next thing I know, I look up at the clock. It's like, oh man, we're running out of time. Well, before we go, I mean, what would be three big, like, if they don't remember anything else from the show, what are two or three big things that people should remember, like when they're thinking about buying or selling a company?
Yeah, so I think good documentation is important, right? I mean, the big difference between selling a company that has good documentation, good financial reporting systems, software, that's a key piece. Having the right team in place. Can they lead the company post sale? The business owner, would he consider rolling equity into a new deal, or does he want to sell 100%, right? Because those types of terms dictate what type of transaction you can do. Because if the owner wants to sell 100% and retire, he may only want to try talking with strategic buyers. Most private equity firms want you to roll. And then I think really taking a hard look at the numbers in the valuation is important. Understanding the real value of your company, not just because I work with sellers all the time, and they're saying, hey, here's a deal where somebody got 20 times EBITDA. How come our offer isn't for 20 times EBITDA? It's like, well, hey, like that, is that a real number? Like, who knows? It could be a stock deal. It could be based on an earnout. I mean, you don't, those types of details matter. Is it all cash or not? So, all those things. I mean, really being educated. There's a lot to learn about a deal, and I think having an advisor work with you is the best way to go for most sellers. So, they can certainly, like we talked about, save you time and money and some heartache down the road.
I'd almost bet money there was an earnout and some type of performance metrics to get that earnout if you're getting
Right.
20x, right?
Right.
Yeah, and I say that there's some crazy stuff going on in the world, right? How can we support you? How can my listeners, myself, what are you working on right now? What can we do to support you? Is there anything we can do to 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 help you out?
Sure. So look, we're always looking for great clients to work with. So business owners that want to sell, that have great businesses that are growing and profitable. We're always looking to work with folks like that on the sell side. On the business valuation side, I mean, we work with all kinds of companies. I mean, you name it. So, we're always looking for great companies to work with. So happy to be a resource for those types of folks.
I'll put one on you. I've got an old military buddy. I'm moving to your area. I'm actually moving in 2 to 3 weeks. I'll actually moving about probably an hour north of you,
Oh wow.
to Sonoma Valley. So
Oh, very nice.
I'll be up there in the next 2 to 3 weeks. I have an old military buddy who's charged me with helping him find a company to buy. So he's going to be an SBA loan type of situation. But keep the looks out for anything that's in that $5 million valuation range that's really well
Sure.
run. He's he's a full time employee, kind of a VP level at a company that does I won't say too much, but it's contracts with defense departments and municipalities. So he loves his job, but part of his retirement strategy is he wants me to help find something that he could invest in, own as an absentee owner, and have me help oversee. So and it's in that area. It's in your kind of in your space. So keep your
Okay.
eyes
Great.
open. You find
Great.
something like that, reach out to me. And as we're going through our search, if we find things that just don't fit, but they really probably need some help, I'll actually I'll send some stuff back to your way, and we can help each other out that way.
That sounds great.
Well, cool. Well, I appreciate you being on here, and if you're good, I'm good. We'll wrap this show up. Hang out for a couple seconds afterwards, and I appreciate you being here.
Thank you.
Thank you, John. All right, that's the show, guys. Hey, it's your host, Ronald Skelton. I want to thank you personally for watching the show today and invite you to call our new hotline, 918-641-4150. That's 918-641-4150. Call us and tell us about our show, ask questions, suggested guests, or even tell me about a business you have for sale, and we'll reach back out to you. Again, that number is 918-641-4150. Call our hotline, leave us some information. Thank you. The Investors and Entrepreneurs Professional Mastermind. The Investors and Entrepreneurs Professional Mastermind combines the traditional peer-to-peer mastermind introduced first in Napoleon Hill's famous book, Think and Grow Rich, with accountability partnering, where your peers help you ensure that you set goals, take actions, and get results. If you want to scale, blow past roadblocks, and achieve success faster than you might think is possible, I suggest you take a visit over to TIEPM.com. That's TIEPM.com and check out the Investors and Entrepreneurs Professional Mastermind.